Yeah. All right, guys. So if I just look back at the performance of the business coming out of COVID, all loan books, with the exception of Greenlight Auto, appear to have bottomed out. What's the dynamic happening at Greenlight Auto there? And I believe we're looking to rejig that some. How can you maybe enlighten me on that?
Yeah, you're right, Nick. I think really the half was quite a V shape as the stimulus was sort of washing through the first quarter of the financial year, and it was getting wound back and demand was picking up. And the unsecured book sort of bottomed out midpoint of the half and then have started growing out like you touched on. The vehicle book was quite different. So with that book, we were engaged in a program to rebuild the product there, overhaul our scorecard, release a new platform, and with demand really falling out of that market due to that, I think primarily that early super access, we really iced that business whilst we rebuilt those components. And now we're back in market and we're seeing some pretty good demand come through and origination volume starting to pick up. Just in summary on the product, you'll probably recall we were traditionally running a 20 to 25 grand 5-year loan product into the market, and we've just pulled back to a smaller loan amount, sort of 10 grand 3-year loan product. Better suited, better risk profile in that market space. It's similar to Money3. It's a lower risk offer with a different risk scorecard. Now we feel we've got that right, where it wasn't quite right before. So as we've launched the new platform with that new product, which gives us that capability to have a broker put a deal on and to have pretty much an instant commitment to a buy based on us sort of analysing the creditworthiness of the client, we're seeing some good traction coming back with the relationships that we had in the past. So we already really had all of the main aggregators and brokers on the platform, but offering the product that they're after with the service and turnaround times that they're looking for, we're seeing some good increase in volume now. We've also put BDMs back on the East Coast out of the big East Coast states where we're chasing that volume, and we're now selling actively. So I think sort of into the second half, you'll see that book started to bottom out and grow again, and that should continue into the second half.
Okay, so just vehicle finance is obviously a big market there to tap into. What's our point of differentiation on the Greenlight Auto product to that of Money3? That's the criticism I've heard about the Greenlight product. Where's the differentiation?
Yeah, I think if you assume product and commissions are all fairly even, it comes down to the relationship with the referrer, the broker or the dealer, and it comes down to the service level. So it's the ease of the referrer communicating to us, the applicant, and the information required. Quite a bit of information needs to be collected, as you'd understand, and analysed. And what we've done is really taken the unsecured personal finance technology that we've got that allows us to quickly build a pretty accurate risk profile of an applicant. We've taken that into that vehicle space and reskinned it for a B2B or broker-dealer intermediary market. And so a broker customer of ours, client of ours can jump on the platform, put the applicant in, put a couple of key bits of information in. We can then pull banking, run a full assessment, and commit back to that referrer a buy decision and an indicative rate that is fairly accurate, subject to then completing a full assessment. And that technology is unique. We've invested a lot in that platform, and that allows us that advantage in terms of that speed of application. And then on the other side, the assessing platform and the technology there allows us to really quickly turn that applicant around and commit to the referrer a deal.
Okay. Going off on a little bit of a tangent here, the buy now, pay later space has really captured the attention and the interest of consumers. A product offering in that space from, say, a cash converts is probably not a link too far from your current product skill set. Is there anything we're assessing in that area as a potential offering, and is there a way for us to tap into that dynamic?
Yeah, there's probably a couple of key angles of that. We've certainly looked at it. I think the buy now pay later sector in general sits outside of the regulated Credit Act sort of framework that we operate within. So we feel that operating under the National Credit Act, Consumer Credit Protection Act, with the credit license and all of those sensible consumer protections is a good thing for our customer base. When we've looked at that product offer, we've considered either developing that ourselves with those overlays, which would be different to Afterpay, who don't run credit checks, etc. And we've also looked at engaging with those third-party providers. But I think ultimately, I think facilitating stock sale isn't our issue. For us, it's procuring inventory. So through the COVID period, our normal inventory level of around $20 million of store inventory really ran down to 12 million. It was quite depleted as people came in with that stimulus cash and bought everything that we had. And a bit unlike a JB Hi-Fi or one of those main retailers that can go and procure more iPhones or iPads to sell, we've got quite a unique model where we've got unique items that we're sourcing. So our challenge isn't so much the sales and turnover side, it's the procurement of stock. So when we're looking at facilitating the retail transaction and offering a buy now, pay later type product to facilitate that, it's less of a priority for us with that in mind than say us developing a different lending product or doing something else. I hope that answers your question.
Yeah, that's good enough, I suppose, to give me a gist there. You did touch on new products in your presentation. Can you elaborate what that might entail?
Yeah, we've got in our subprime market space, we've got really an up to $2,000 loan and an up to $5,000 loan at this stage. We've got a pawnbroking offer and we've got a vehicle loan through brokers and dealers. So I think in that market, it's a growing market. It's over 3 million of the Australian population now are excluded from mainstream finance and can't get a credit card or a personal loan, for example, from a bank. We see opportunity to continue to sort of build off that base that we've got. So our product development is really targeted at enabling people to meet their cash needs to get on with their lives. And if they're coming in for a loan product that we have at the moment and their risk profile is not suitable for an unsecured loan, for example, we'll offer them going forward potentially a title loan or a secured loan option where you can bring an asset like a car to the store and take a loan against that asset. And it's that sort of product development that's still built around that core subprime market that we're really focused on. We are also looking at, I think a lot of borrowers are coming to us with a lot of buy now, pay later on the 90 days of banking that we have to review as a responsible lender. Under our obligations of suitability, we're having to decline these borrowers because they're overcommitted to the buy now, pay later providers. And we've got a refinance product that we've developed that would take the borrower out of that unregulated buy now, pay later space into the regulated credit space, whereby paying down those obligations, we can then lend them money that then will see them, back to some sort of financial health that makes a loan suitable for them. So it's those sort of examples. We've also got finally a direct-to-consumer car loan coming through. We do receive quite a few website and store inquiries about pure car finance, and we've developed a B2C car loan product as well. So they're three things that we're working on over the next sort of couple of months to release.
Okay. The cash converters name might seem a little bit old, outdated, stale, maybe to some aspects of the population. Is there any need or intention to maybe modernise the name, rebrand in any way, or are we comfortable with what we've got?
I think in our markets, the brand is very well recognised and trusted, and we run really high NPS in our customer segment. So we're over 60 NPS. So I think it's not a brand that's designed to appeal to the masses. We deal in that subprime niche of the 3 to 4 million Australians that I was talking about. And the investment in the brand in that customer segment has great traction and trust and recognition. I think constantly refreshing the brand is something that we're always doing, and I think you will see the brand more visible in through AFL sponsorships and other promotional mechanisms that we've now got available to us. Now we've sort of cleaned the business up and we've got that product set coming through. But we don't plan on rebranding. That's our strategy. It's to take our brand wider into that subprime and near prime part of the Australian economy that's growing. And to that respect, we consider with 150 stores within Australia that we've undersaturated the physical store network footprint as well. We see an opportunity to grow that store network over time as well, in a measured way. But there are many good territories where we're not represented at all, and we see some opportunity to add some more corporate stores.
Leslie, a question for you. Are we paying income tax? I thought we had some retained losses we're sitting on, but the cash flow statement shows we paid, I think, $950,000 last year, or in the first half.
Yeah, so good question, Nick. We do have an assessed loss brought forward from prior years. What you're seeing in the cash flows, there's still a bit of instalment payment going through, which probably settles post the income tax return having just been lodged in January. And then we just get a reassessed instalment pattern. It's something we could be a bit more assertive about it in cash flow, but I tend to find, just working it gently through with the ATO is a better approach than varying instalments ahead of returns being lodged.
Cool. Appreciate that. I'm a little bit perplexed as to why we are offering a dividend reinvestment plan with the stock at a discount to net asset backing. I'm pretty sure I asked the question previously and you thought that we weren't going ahead with a DRP. So can you correct me on this matter?
I've probably come at it from two different perspectives. I think the one side of it is, reflecting on, I think it's been 5 years since the dividend was paid, and this is the first one coming through. Where we're at is a DRP that was in place 5 years ago, and is, kind of there by default. We could have looked at removing the DRP or varying the DRP as we came through this cycle. But the view we took was, one step at a time, maybe, Nick, is the way to look at it. We're very happy to be returning to the dividend paying and heading in that direction. But it was kind of, keep things constant, and it's something we'll review going forward. And that the discount that's in that DRP is just existing in the existing rules. Now, having said that, the other way of looking at it is, the sort of philosophy on the DRP overall is, I suspect some investors, particularly retail, happier to see a DRP in place and an ability to participate at that type of discount. I'd imagine the large institutional investors don't like it because it's, a type of stealthy capital raise perhaps and dilutive. And I guess in this phase, we've just kind of gone on the basis of you can't keep all of the people happy all of the time, but we're trying to keep as many of the people happy as much of the time, and we'll just review it as we go forward. Okay.
All right. So we still have a lot of cash on the balance sheet. You elected not to do a special dividend. Are we thinking that you're going to need to draw on this cash to fund the loan book growth predominantly?
It's certainly our intent through this growth cycle. We've had to think about growth in two different ways, and I'm really referencing the impairment testing that's been done on goodwill and the disclosures around that in terms of impending legislative changes. Those changes are uncertain and could go either way at this stage. So if we look at it on the basis that change does occur, there is a dip in our lending volume, sort of F22 and F23. Notwithstanding that, we're deliberately funding out of cash resources. We're keeping the debt drawn at that minimum drawn limit. So there is capacity for us to draw both in advance rate and in terms of receivables that aren't in the warehouse. And really the next phase for us is this legislation settles mid-March one way or the other from what we're seeing. We'll have a better view then in terms of the landscape beyond. Sam's touched on some of the new product development that's in there to underwrite should the legislation come in, and then it's a useful adjacency if it doesn't. And then, the capital plan really then starts to get set from there, both from the perspective of, use of our capital, use of debt, and also thinking about, tenure of deadlines beyond December 22.
Okay. All right. Greenfield sites for store expansion on the East Coast. I'm presuming there's some pretty good real estate deals around at the moment for retail.
Yeah.
When do you expect to make moves on this front?
We certainly are intending to open greenfield stores, and I think we've sort of shortlisted nationally around 40 locations that we think the demographics and the mix of population makes sense. We kind of shortlist down to some prioritised sites. For example, particularly around Geelong and those areas where we're underrepresented, and particularly in New South Wales. And we kind of will run a process to cost out and approve those openings subject to site location being found and reasonable terms being agreed. And so, at any time we could have a handful of lease negotiations underway, and if we find a nice site and we can find the right sort of lease and terms, then we'll do it. So we've had a pretty good track record over the last 12 months of renegotiating leases, as you'd expect, and finding potential sites, and a couple of those conversations have well progressed. So certainly a good time to start to do that now, and that will then complement also the acquisition of franchise stores that we've got underway, of which we've settled 2. We've got 2 about to settle, and we've got another 2 stores that are close. So that will see the corporate store network expand over time, sort of floating the total store numbers up as well, towards that 200 mark over maybe sort of 2 or 3 years is the intent, from the circa 150 now.
You return to dividend payments. Is that sparking a bit of renewed investor interest, inbound inquiries, want to know more, that sort of thing?
My view is I sort of see that as rewarding our current shareholders who have been supportive over time, and we've been fortunate to have some pretty good institutional support, and that was sort of about going back to signalling to the market as well that we're confident in our outlook, and we've picked a level we think is sustainable, that would allow us to fund all of our growth initiatives, but to commit to that going forward. So let's hope retail investors take that as a good sign that we're strong and growing and we're back. And if we can start to jump into some of those screens that are run for yield and get a wider following, it's certainly going to be a good thing, and that's what we hope happens. But primarily it was about thanking and rewarding our current shareholders, and it's been really well received in that respect.
Any other remarks as closing argument you'd like me to take to clients going forward, or is it already summed up?
No, I think on the dividend, there's a big franking credit balance, as you'd know. So we're looking at, how do we release that asset? As we look at our funding strategy, we're funded by it's a US-based hedge fund. The terms aren't too bad, but we'll look to diversify our funding sources. And I think operationally, there are so many areas of the business that are exciting in terms of the way we're optimizing our platform. Just one example is bringing our collections process back in. We under the history with ASIC, through the enforceable undertaking we had with them about 4 years ago, we outsourced our collections function. But late last year, ASIC supported the return of that function back internally, and that will have a huge benefit for our lending business as we fully control our customer experience. And it's sort of one example of maybe 4 or 5 really key things that we've got underway in that part of the business that will see costs down and service up, and really bullish in terms of our outlook for expanding into new markets, what we do well, taking that service in, putting those stores in, and dealing with more people. I think we're in a pretty good position when you look at our cash and our balance sheet to continue to execute and grow.
All right, thanks, gents.